Hello, thank you all for joining us today. I'm Anthony Wilhelms with Nicolet Bank. I am Vice President and Financial Advisor. To my left is Mike Steppe, Senior Vice President and Chief Investment Officer with Nicolet, and Adam Longley, Senior Investment Officer with Nicolet, and both Mike and Adam are CFA charter holders, as am I. And we're really excited to talk to you about 2020, 2021, the economy, and a variety of topics. Mike, I'll get started with you. There were a few things to talk about during 2020. You can take your pick from a recession, a pandemic, an election. Give us an overview of what happened in 2020.
Okay, as I think about it, going back a year, if you think about the start of the year, we were growing at sort of a modest pace in the economy. And then we hit this air pocket. The coronavirus hit, and all of a sudden the economy shut down, or at least substantial portions of the economy shut down, and we got this slowing down of activity, and you saw interest rates shift down. So interest rates fell by over 1%. I think when people look back historically at this, they're gonna go right away to what the Federal Reserve did. So the Fed stepped in and very aggressively brought down rates. So they brought short-term rates down to near zero. On the longer end of the curve, the Fed really controls short-term rates. On the longer end of the curve, they stepped in and they just started buying. And they did this, they could see that politically there wasn't going to be much that was going to be accomplished, at least quickly. So the Fed jumped in action-wise, and they bought a lot of longer-dated securities, Treasury notes and mortgage-backed securities, driving down interest rates or pulling them down. And that worked. It did what they anticipated it would, and so that stimulated the economy, and we wound up experiencing sort of a U-shaped or a V-shaped recovery, and that's what we've sort of experienced, is that sort of play out. Now, that created winners and losers. So when you look at interest rates last year, we got this move down in interest rates. Bond markets reacted. The aggregate bond index, which is sort of the benchmark that people use, was up a little over 7.5% last year. But the Treasury notes did better than that. The corporate bonds did better than that. So there are winners, and the Fed was effectively, by what they were buying, they were picking the winners and losers. And so that makes it an interesting market. The losers were mortgage-backed securities, because the Fed was trying to get more mortgage refinancing going on to lift the economy, and also muni bonds. Both underperformed the aggregate index. So we saw that sort of play out.
When you're talking about municipal bonds, we saw, or at least from what I've heard from you, we've seen kind of a divergence in some of the credit quality and of the municipal bonds. Can you speak to some of the municipalities or things going on in that market?
Sure, it's been really interesting this year because you have seen that. What's happened is there are clear losers. And again, the Fed, by what they're doing, has created some of this. But the bigger cities have really experienced a very negative environment in terms of, number one, sort of when the economy shuts down in Chicago and people aren't all coming in, it hurts their restaurant, it hurts all the other things that are going on in that city and all the sources of revenue. It also hurts because their expenses are steady. They don't drop with the decrease in revenue. So from a municipality standpoint, they really struggled. And that's what we're seeing. Bigger cities, more problems. So you see a city like Chicago, if we use that as an example, they were already in dealing with a structurally deficit position that they sort of chronically had. And so then you see their debt get downgraded to below investment grade. And you see the problems, and the revenue shortfalls are going to continue. And so those become very problematic. Other cities have much less of an impact. If you look at Appleton, okay, it doesn't have the same impact as a city like Chicago would have. Sure, I'm sure there are negative aspects that creates for a city like Appleton, but it's not nearly the magnitude that you'd experience in Chicago.
That's great. Adam, I'm going to come to you with a question about equities. This has been quite the hot topic in 2020. Give us an overview, and then I have a few specific questions for you.
Sure. 2020 for equity investors was a very challenging year. And for those who could stomach the volatility, it was a really rewarding year. The amount of volatility in the market in 2020 was well beyond what anyone expected in the beginning of the year. But I think to put it into some context, you have to go back to the start of the year. And remember, we came out of 2019 with the stock market up 30%. We were feeling pretty good about the market. The economy was doing well. As an investment committee, our conversations were around, all right, we're at the tail end. We're in 11 years into this bull market. The market's up 400%. How does this end? This can't go on forever. And when we looked around the landscape, you couldn't really identify any bubbles. There was nothing you could point to and say the housing market's going to cause a recession. The banks are being too risky. And at the end of the day, it ended up being a global pandemic, which no one expected. But up and through February, the market was up 5%. Things were going very strong. So I think that's important to remember that we started the year and went into this global pandemic in pretty good economic footings. And then we had the fastest bear market ever. The market fell 34%. So that ended the 11-year bull market, started a new bear cycle. And then the government came in, as Mike spoke about, with the CARES Act. Unprecedented amount of stimulus and relief entered the market. That really shortened the duration of the drawdown. And it also provided some relief, and that really marked the bottom. So from that point forward, the equity market rallied 70%. And it ended the year very strong. And if you think about how the year started and how the year ended, it was pretty similar. The first 2 months of the year, we set an all-time record high, I think 13 times. You look at the last 2 months of the year, we set 9 record highs. So it was all said and done. The S&P 500 finished up about 18.5%. Which is a very strong year. If you look historically, last 50 years, the market's up about 11% annualized. So it's a better than average return, very strong. If you look at different markets like the NASDAQ, that was up about 45%. The year before it was also up quite a bit. So that 2-year return is 100% for those tech stocks. So that part of the market did exceptionally strong as well.
Well, stay on that topic for a moment. We've talked about breadth of returns and FANG stocks. You can explain that acronym and how that happened during 2020, and then if that's changed at all going into 2021.
Yeah, so if you go back to 2018 to put it in a little bit of context, the 5 biggest tech stocks in the S&P 500, the Microsoft, the Facebook, the Google, the Apple, those 5 stocks make up about 25% of the market. So for the last 3 years, that part of the market's up 130%. The other 495 stocks in the market are only up 30%. So that trend was already in existence before COVID, and then what COVID did was it really accelerated it. Those companies, if you think about it, they really benefited from the stay-at-home and the social distancing. So their earnings benefited, the stock prices benefited. So at one point in the summer of 2020, the market was up about 9% year to date. 93% of that return came from those 5 stocks. So you had very little participation with the rest of the market. If you look at how the year ended, the last 4 months of the year, those 5 big tech stocks, they were down 2 or 3%. The overall market was up about 6 or 7. So that means those other 495 names were up about 10. So you did see a lot more breadth in the market. You saw a lot of different sectors participating. So it's really positive as we look on to the next year to see that other parts of the economy are contributing.
Well, I like the good news heading into 2021. Mike, I'm going to come to you to tell us what's going to happen in 2021. There have been a lot of trends that kind of emerged in 2020, on-premise to carry-out, e-commerce from brick and mortar, on-site working to working from home. What trends are you seeing into 2021?
There really are clear winners and losers, and that's what, as you think about what's happening in this world, you're getting these big secular changes. More employees are working from home. You've got retailers dealing with all the different ways people want to buy goods and services. So you've got all these changes, and this is playing out. People are now going to their doctor, telemedicine. Going back to Adam's point about trends accelerating. You had already seen some of this stuff, and the apps were out there. It's just now, all of a sudden, it just accelerated so much faster. And sort of when you look at sort of the big four areas that I think about in terms of impact, office space, big impact. Retailing, big impact. Medical care, again, big impact. And education. All of those are experiencing massive changes because of this, or those trends are accelerating from what were already in place. And that's what we're seeing.
Any kind of guidance as it comes to unemployment or employment? Changes in kind of work environment, work location, anything like that?
Well, great question, because a lot of it we don't know. And that's what we're sort of dealing with right now. When we hit this air pocket, I think of it as an air pocket, because we were flying along at a pretty good clip, and then it just dropped. And when that happened, 21.1 million jobs were eliminated. And so now we've bounced back, but we're still 10 million below where we were before. And so that's the experience. I think when you look at sort of how you think this is going to play out, it means we're going to grind away at this, and it's going to get better, but it's the advances that we've seen, which were pretty dramatic bounce back, are probably going to be slower now. And so, yes, we'll go from under 7% unemployment rate to over the course of the next year to a 5.3 or a 5.5, but it's not going to get back under 3%. It's going to be a grinding to get there, because there's skill gaps in terms of what the jobs people are looking for. So employment's going to be a struggle this year.
Right, and I think those location gaps will happen with unemployment. We see unemployment very different here than other places nationally.
Yes.
Adam, I'm going to come to you on valuations. You talked a little bit about some of the kind of support for markets through the early part of the year. We entered 2020 with relatively high valuations. Then they plummeted as earnings it went much lower, and now back at relatively high levels. What do you see going forward?
Yeah, the valuation on the equity market it's a very interesting topic, and it's important to understand. Where we sit today, we're about one standard deviation above the long-term average. So what that means is we're slightly expensive, but I think that's okay in the context of, if this is the beginning of a new cycle, you should expect to pay more for those earnings, because there's a cyclical rebound component. Earnings growth is going to be very strong at the beginning of the cycle. So if you think about a cyclical company, earnings go up and down, but they trend higher. So you should pay a higher multiple when those earnings are at the bottom of that cycle, which is where I think we are today. The other piece to think about is how low interest rates are. So if the value of a business, the value of a stock, is its future cash flows discounted back, if interest rates are really low, that discount factor is really low, you should pay more for those earnings. So in that context, I think we're okay. How this plays out, to the question is this higher valuation environment that we're in today, is this the new normal? Is this going to stay? Or do we revert back to the long-term average? I think we do revert back, and that happens in one of two ways. You either have some sort of correction. If the market's at 22 and there's $1 of earnings, it's a 22 PE. If that market corrects 15% down to 18.5, you're now at the long-term averages. So that's one way. But what I think is going to happen, is more likely to happen, is because we expect growth to be so robust, if those earnings grow at 30%, the market can still appreciate by 10%, and you get back to that 18.5 again. So I think something like that, where you grow into your multiple, is more likely. The other important thing to think about is, if the market's at 22 times forward earnings, and if you think about those 5 stocks that make up 25% of the market, those are trading at over 30 times. So the rest of the market, those 495 other names, those are trading at less than 20 times. Less than 20 times is pretty close to that 50-year average of around 18. So it's not maybe as expensive as it appears, but I think growth is so expected to be so strong, we can grow into it. It still looks positive.
Those are great points. I appreciate that insight. I want to piggyback off something Mike said about interest rates and support from the Fed on keeping rates down related to kind of how you talked about the discount rate or discounting those future cash flows with really low interest rates. Without that type of intervention to hold rates down from the Fed, can those multiples or the valuations be sustained?
It's unlikely. If the thesis is based on those 2 points, strong growth, that continues, but the low interest rates is a very important component. The other thing too is if interest rates are higher, now your fixed income looks more attractive, and that's going to compete with capital for your stocks. So it's not, as you put together a portfolio, that's not necessarily a bad thing to get some rate and be able to buy some bonds. But yeah, as interest rates go higher, eventually that will put pressure on the equity market.
Well, you make me think of a question I'm going to come back to you, Mike, about what to do how to generate yield in the event of a liquidity event. But Adam, I'm going to stay with you on a question related to inflation. And we've seen relatively benign inflation kind of in the face of pretty significant fiscal stimulus, and monetary. Do we anticipate that persisting into 21 and beyond?
I would. You have all this stimulus and money entering the market, and it's obviously inflationary, or should be. So I think it's a timing issue. You also have a lot of unemployed, and there's a lot of slack in the economy. So I think at some point as the market firms up, there should be some inflation. But I think it's unknown the timing of the event. But there's also a lot of stimulus that entered the market in the global financial crisis. We never really got the big inflation that you would have expected. So it's a little bit of a new dynamic, but it's something we're watching closely.
Mike, I know you've talked about kind of innovation and product development and efficiencies as a kind of putting a lid on inflation. Can you speak to that?
Sure. There's a longer-term secular trend that we're seeing that a lot of the innovation, you drive by the Epic campus in Madison that are working on hospital digital records and doing all that, and all that's trying to cut a slice of expense out of hospitals. And so when you look at that, it winds up having an impact that all this innovation, just at the bank as an example, we've offered all these digital products, but people were slow to embrace them. Now we have COVID-19 and everybody thinks it's natural to take out their phone, take a picture of a check, deposit it, and that's how we're doing it. People say, wow, this is really a great product. And we've had remote deposit capture for years, but all of a sudden now people are embracing it. And all of that cuts costs out of the system. And so that's disinflationary. It takes inflation down. We're going to get some inflation because as people get vaccinated, and assuming that rolls out without big problems, when you look at that, people are going to now take trips. They're going to go out to eat more. There's pent-up demand for a bunch of things, and you're going to see price increases because everybody's going to be going for that at the same time. It's going to be a timing issue. So we're going to get some inflation, but the general undertow is pulling inflation down because all this innovation that you see in the market, it effectively cuts costs out of the system.
That's a great point. Well, I'm going to stay with you, Mike. We've talked about equities, we've talked about fixed income and inflation. Can you put kind of a wrapper on that and give a bit of our macro or our longer term outlook for both the US and globally?
Sure. As we talk about it as a group, we sort of think there's going to be four sort of key themes this year. The first one of those is equity valuations are going to stay relatively high. So the market's going to be volatile. You're going to have sort of choppy periods. Market pops up, pops back down. But in general, at the end of the year, you're going to look back and say, wow, in general, for the course of the year, equity values were high. Second thing is you're going to see inflation pressures are going to be modest. I spend a lot of time thinking about where inflation's going to go because for our clients, it's all about what the purchasing power of their money does. It isn't, what our gross return is. It's net after fees, after inflation, after taxes. So we worry about that. And with inflation, you're going to see that probably this year about 2%. There's going to be a few periods, especially as people go out and start taking trips and start going out to eat, where it'll be a couple months in there where it's going to rise above that, but that's okay. The Fed sort of anticipates that, and that's going to continue. The third thing that I think is going to be a key theme this year is the US dollar is going to weaken. And that we've had this period for the last 10 years where the dollar has strengthened. And so we're going to be in sort of a new environment with this. And so that's going to change things as you look at it for emerging markets, and international investing are going to do better. And US companies, that's going to help them in terms of their revenues. So the US dollar weakening is going to be a big thing. Lastly, I think in terms of interest rates, you're going to see the short rates are going to stay low. But I think longer term maturities are going to go up a bit. Not like crazy up, but I think you're going to look at rates going from 1% to 1.5%, 2% sort of levels on 10-year treasuries. So I think you're going to get sort of what we call a steepening of the yield curve, where longer maturities go up a bit more. I think those four key themes are what we're going to see this next year.
That's a great point. Adam, I'm going to come to you with one of those themes related to US dollar weakening, emerging markets, and how can investors benefit, or business owners, from a weakening or softening US dollar?
Yeah, the weakening of the US dollar is a big investment theme, and it's important. Like Mike said, with that dollar strengthening in the last 10 years, over that same time period, US stocks are up 300%. Emerging market stocks are only up 70%. It was a headwind for them. Now, if that reverses, it's going to be a nice tailwind, a very important tailwind. That weak US dollar is also good for commodity prices, which is also good for emerging markets. Also within emerging markets, you've got higher growth, both GDP growth, and the companies themselves are also growing as well. The yield differential isn't much different. In the emerging markets, it's the emerging middle class. You look at millennials in the developed markets, there's 5 times as many in the emerging markets, eating meat for the first time, buying their smartphone for the first time, flying for the first time. Those are all important drivers of growth in stock prices. And then valuation. The valuation in emerging markets is more attractive, arguably, than in the US. Today, emerging markets are 30% cheaper than US stocks. Now, they should be cheaper. They're higher volatility. Their accounting arguably isn't as clean. But historically, that discount's been around 20%. So they're cheap relative to history. Within that, emerging markets, the way we like to do it is through active management, active stock picking. If you look at the emerging market sector, it's improved over the last decade as it's gotten more attractive from a valuation perspective. 10 years ago, there's a lot of state-owned banks, state-owned energy companies. Today, it's a lot of healthcare, technology, consumer spending. So it's gotten cheaper and it's gotten more attractive. And so the way we like to play it is through active management, active stock picking. So we like managers who have an emphasis on the downside protection. Managers that can participate 100% on the upside, but when that emerging market goes down, they only go down 70 or 80% as much. So as we introduce that into client accounts, we have an asset class that's more volatile, but because we're picking active management with a downside emphasis, we can mitigate some of that. And it's just another differentiated source of return and an opportunity in a depreciating dollar.
Thanks for that. You mentioned good for commodities, and I suppose good for commodity values increasing, not necessarily good for commodities or business owners that are consuming commodities. Can you speak to just natural resources or real assets in a general sense going forward?
Sure. 2020 is really interesting for those real assets. Historically, those are low beta equity strategies. They act defensively. And it just didn't happen this time because of the unique nature of the bear market in COVID. So we're talking about things like listed infrastructure, things like U.S. Global toll roads. People tend to drive regardless, right? But if you are ordered to stay at home, you can't do that anymore. People used to use airports regardless. Utilities did not hold up as well as they normally would. Part of that is people didn't go to their office building and consume energy. Another part was we We had wildfires, which were a headwind for that sector. There's also some rate issues. So it was unique in that some of those assets didn't hold up as well. Now, that has created some opportunities in some places. So as people get vaccinated and they begin to travel again, that listed infrastructure should do well. And in the meantime, it's yielding 4 or 5%. It's got significant upside potentially because it has underperformed. Now there's parts of real estate, global real estate, where maybe it stays challenged for a while. You know, there's arguably too much square footage for retail space. And there was a nice trend where they would take these malls that weren't being used and they were filling them with movie theaters, fitness centers, but now maybe that doesn't happen because those industries have their challenges as well. And then we don't know exactly how people are going to return to work and what that's going to look like. So that could be too much square footage. So that might be an area where that's not as attractive. But you have also, you know, energy. At one point this year, you know, if the S&P 500 in 2020 finished up 18, energy finished down over 30. That's 50 percentage points of underperformance. And at one point it was even worse. In the history of the S&P 500, no sector has ever underperformed by that much, right? That feels like an opportunity potentially, especially with Saudi Arabia recently announced that they're going to cut some production to boost the price higher. So we think maybe there's an opportunity in energy as well.
That's a great point, and I think you talked about yield a little bit. And Mike, we have, as bankers and advisors to business owners, we get a lot of questions about how do we get income generation after liquidity events or if we sell our business. Mike, where are investors finding yield?
Well, not in overnight rates. And that's the first part that you start with, is you really have to look and say, wow, if the Fed is going to keep rates low, then you have to extend out further on the curve to be able to get a little bit better yield. I think some short-term bond funds are an appropriate place to invest right now that give you a little bit more yield. Not a lot more yield, but you have to pick. There are sectors in the equity market that provide a decent return in terms of dividend yield that are attractive. And so you've got to hunt for more than you used to because rates used to be more attractive. They're just not. And as long as the Fed is going to hold rates artificially low, and they're going to do that for at least the next 2 years, you're going to be in this period where you have to really look creatively at what you're going to invest in for that yield.
What do you see from the equity side, if you kind of step out to the equity side, from yields or opportunity for investors to generate income?
Well, that's a question for Adam on that.
You know, and if you get creative, there's things like publicly traded partnerships. These are largely energy companies that have structured themselves as pass-through entities, limited partnerships instead of a traditional C Corp. Today, that sector is yielding 10%. It's actually very high quality today. You know, those businesses, the cash comes in, they pay for CapEx, they pay their dividend, and they're still free cash flow positive, to the point where 80% of them are now buying back stock. So they're very financially fit. Companies are very attractive. Those cash flows are really resilient. And then you got that really nice 10% yield as well. You know, we talked about global listed infrastructure is yielding 4 or 5. Global real estate's 4 or 5 potentially. Energy stocks are probably around 3%. And they historically have been low beta as well. So there are parts of the equity market that offer the capital appreciation potential, and they also have a higher dividend income than most of the fixed income market as well.
That's a great point. Mike, I'm going to shift us to kind of some PPP and some things that happened during 2020. Can you speak to what the bank did, what Nicolet did, and maybe more broadly related to the PPP program?
Sure. This year, the big event in the market was this PPP set of loans to entrepreneurs. And that's a really important business for Nicolet. We're an entrepreneurial bank that started from scratch 20 years ago, and that's our mindset is, what are we going to do for these people? We made $340 million in loans during that period to 2,600 clients. And the average loan size was like $130,000. So we saw, you know, our customers sort of tapping into that market. There's going to be another set of those loans, and we'll see how that plays out. But I think that's going to stay in the forefront, is participating in these type of government programs. Also, our foundation stepped up, and for some of the smaller players that wanted $3,000 or $5,000, our foundation just made those as sort of a grant to the company. And so it's been great that we could support those community-oriented entrepreneurs during this really challenging environment. This is a terrible environment for an awful lot of companies because the way customers are buying things, the way other businesses are buying stuff is changing. And you've got to be really agile in that kind of a world. You got to be able to adapt. And for some companies, that's really difficult. It takes some time to be able to do that. And the one thing you have this time that's different is you don't have time. All of this happened in such a condensed period of time that it's made it really challenging. So for some of these people, that was the bridge that kept them alive.
That's a great point. When you think about all that money from the PPP loans, and what we're seeing nationally is the businesses that are doing well or are surviving have record levels of cash on their balance sheets. What do you think it's going to take for that money to get invested or spent?
Well, it starts with the idea that we had all this uncertainty. So it was a natural response of businesses to look at this and say, wow, I'm really nervous. As I talk to people, that was the natural reaction. And so we're going to continue to see that. When people feel more confident, you're going to see those cash balances start to come down. But that's what it's going to take, is a level of confidence that I know what this looks like. I'm not worried that all of a sudden the economy is going to shut down and I'm going to be scrambling with my revenue dropping like a brick. So I think businesses, especially in Wisconsin, we have a very conservative mindset, and that's what's allowed them to survive. And so, but I think that's the kind of experience that we're having right now, is people say, yeah, prove it to me. Prove it that this is going to be sustainable, and then I'll start spending again. But until then, I'm going to be pretty reluctant. I'm going to hoard a little cash here, and I think we've seen that.
Well, those are great points, and a lot of reasons for optimism, it sounds like, into 2021. A lot of prudence on behalf of businesses and good positioning going forward. Well, I could ask Adam and Mike questions for the rest of the day, I think, but in the interest of time, I want to thank you all for allowing us to join you, and remind you that at Nicolet, we're a team. You have portfolio managers and fixed income specialists like Mike and Adam. We have commercial bankers, we have retail bankers, personal bankers, and trust officers, estate planners ready to help you and your business. Mike and Adam, I'll turn it over to you in just a moment for some parting thoughts from you. I also wanted to offer to the audience, we do have a series of webinars that are previously recorded. You can just Google Nicolet webinar and find webinars. We have Mike Daniels on some of them, one of our co-founders, and Bob Atwell. We recently had Charles Guthrie, the athletic director at UWGB, and someone you're familiar with, Brian Bolio, this summer. So you can check that out if you Google Nicolet webinar. With that, Mike, can you give us your parting thoughts?
I think this is the time to really focus on earnings. So if you look out over the next year and you're thinking about different companies, really focus on what are they making? Who are their customers, and are the customers buying stuff from them? And I think if you stay focused, there's so much emotion in the market right now. And if you could take some of that away and make it more quantitative and say, what were they earning before? What are they earning now? I think you get to better answers and better decisions.
Adam?
Yeah, I think we are constructive on the equity markets, and if you look over the last 50 years, on average, the equity market's up about 11%, but that hasn't come without a fair amount of volatility. In 2020, the market fell at 1.34%. In 2018, it fell 19%. So on average, at some point in the year, it's fallen 14%. So I would encourage everyone to think about that volatility as an opportunity. If you have a taxable account, that might be an opportunity to harvest some losses. Maybe make some changes in your portfolio that you couldn't before. In your qualified or your retirement accounts, there may be an opportunity to convert some assets to a Roth. But either way, there's lots of opportunities, and I would encourage anyone, if they need help, that's what we're here for, so please reach out.
Well, thank you, everybody.